Welcome to the Capital Discussions OptionVue Education Webinar Series. I'm Tom Nunemaker with our guest Jim Graham from OptionVue Systems International. Before we get started, a quick disclosure, the Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and I have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. And again, this is for educational purposes only. So with that, I'll stop sharing, and Jim, I will transfer the presenter role over to you. Here we go. And while we're doing that, just want to say welcome back. It's been a while, and always a pleasure to have you and have you on as a guest and get to know you a little better. Talking about the old military stuff we both did.
Yeah. Well, always glad to be on, and just thought people can ask questions if there's something specific they want to know about. I was just going to go over a few things that are in the software. One thing I find is that there's just so many little things in the software that many people don't even know is there. And so I thought I'd try to point some of them out, including in our charting, some of the features available. Maybe I'll look at, I want to show one specific example of how to use Trade Finder. And then I'll look at, we have earnings here coming up, so I'll look at a few earnings because I think one thing with OptionVue is automatically bringing in earnings and projecting the ramp up in volatility and drop is something no other software does, and it's just it's basically impossible to trade earnings without this. So I think it's our most amazing feature. And finally, I'll just look at some of the other few little things. I try to keep it around 30-40 minutes, so it's not so long. I found that's what we've done with our YouTube. Try to keep things at 30 minutes. People's time spans are getting shorter and shorter, I think, every year. Used to have short videos and the things. So we've gone from the hour to 30 minutes and found actually the amount of time spent watching the video has gone up quite a bit. Because someone doesn't say after 5 minutes, they don't say, I still have 55 minutes of this. It's like, I'm getting out of here.
Right.
But I'll start. Well, let me go in and I'll start sharing my screen.
Okay.
And we'll talk about. You had asked about what he's working on with the modeling.
I saw that in the release notes that you're working on that.
It's something that we tried to do once before, and we had already started working on it. And the basics behind this is getting a better fit of the volatility skew curve for the curves. Just right now we're using what would be a quadratic equation. It describes a parabola, and with the parabola you can, a curve can be described in a single equation as a curve, and you can, what's the shape of the curve? That's part of the equation. But you can only get so much, like granularity is maybe the best term, to get it as close as possible. So he's really working on what would be a multivariable equation for the curve to get it a closer, better fit. And when we released it before, it ended up having a few problems. And so we went back to the old model. Now he's ready to do it again, and how we're going to be implementing it is he's going to create a completely new model. Won't be touching the current model in OptionVue. It will be available as an additional model, the new model, and we haven't decided exactly what to call it. So don't have to worry about it affecting anything. You can always go back to exactly how it is now if there's any problems with it, because it is it's right in the heart of the program. So it's extremely important, but potential for a lot of problems.
And if I understand correctly, you were going to make it optional if people use the new modeling or keep the old one?
yes, it would be completely optional. Just like now you can switch between variable model or EIOIO or even uniform model.
That'll be great.
So let me go in. I guess one of the first things I was going to look at was just looking at our price charts. When you open a price chart, I'm just going to look at the SPX. One thing in it that I think a lot of people are interested in, like to look at, but I don't think a lot of people realize we have it, is in our price charts, we have put-call volume ratios available as a lower chart reading. We actually store we click the settings button. For put and calls, you can create a put-call ratio, puts calls, puts plus calls, and puts divided by calls plus puts ratio. But the put-call ratio is the standard thing a lot of people use as an indicator. But we keep the volume of the puts and calls and the dollar volume of the puts and calls and the open interest. All that's stored in OptionVue for every day going back like 10, 20 years now. And you can adjust it however you want, but I'll start with looking at like a simple put-call ratio. And I'll look at dollar volume. And I'm not going to do an average, just one day, day by day. And hit OK. And here's where you show the lower chart. It opens up. So you can see here's the put-call dollar volume. And here's where you can see as it spikes up, that means a lot of people are buying puts. You can really see, and I found this interesting, that this year it seems like people are kind of nervous. The market just keeps grinding up and up, as you can see from the chart. Like you can take a little line and just draw it. It's like basically it's been going up and up and up, but not dramatically, just grinding up. And every time there's just even the slightest little dip, people get so nervous. Okay, here's where the market's going to, market correction come in. The market's going to drop. You see it with the VIX. The VIX tends to spike up more, it seems like, recently than it used to. And let's look at some of these times when they really, you see, like here's one drop day. Maybe it's what, a 1% down day? Boom, 6 times more dollars in puts versus calls. You can see most of these other days, down here at the bottom is where you see the actual number, 6.63. Let me just go right out of it. So you can see like right now, a lot of times we're below 1, which means more calls are being bought than puts. But whenever you see these spikes, they correspond to the market's just dropped a little bit that day, usually less than 1% or about 1% or something, like right here. And you can see every time they've been wrong. As soon as it goes down, they buy all these puts and boom, it starts moving up. Same thing over, let me turn off this line. Same thing over here. People piled in the puts, just started moving up again. So I thought that was kind of interesting. And of course, people who are familiar with the put-call volume ratio, it is what's considered a contrarian indicator, meaning the crowd tends to be wrong. If they think that if they're buying a lot of puts, then the market's probably going up.
It's really neat that that's available. I didn't know.
And if you really want to get into it and just see the actual data behind it, add a couple more lines. We'll just look at the actual puts and the actual calls. Again, I'm not going to do any kind of average. It's just a day-by-day reading. Dollar volume. And hit OK. So it added these other lines. Actually, I'll just get rid of that, the ratio, just to make it a little easier for you to see. So here's the actual data. This top purple one is the puts, and the red one underneath is the calls. You can see typically there's always more put buying, or I can't say it's for sure buying, but more put than call dollar volume. You can see it's the puts that spike. People are always buying calls. That rarely spikes. Here's one of the few spikes right there. And actually, the market did go up. Had actually gapped up a little there after all those people bought calls. Here, not much happened. Here, it did grind up quite a bit right after people bought a lot of extra calls, but they were buying just as many puts. Now let's take a look, and you can see the actual contract volume, which is what the volume means, how many contracts are actually bought. Again, you can see more put contracts and call contracts. I tend to use the dollar volume because if you got people buying a ton of far out of the money stuff, it can skew this one where you really want to see where people are, they're putting their money where the mouth is. I just wanted to point that out because I think that gives you a lot of information on. It's great on SPX, but you can use it on any item. For example, it doesn't have to be an index. It could just be a stock like Adobe. And take a look.
It's a nice little hidden gem there.
And a couple other interesting things, I think, in the profit zone. Do I have any positions in my test account? Oh, yeah, I just have this call and guild. Is when you have a chart, you have to have the price chart open. I'll get rid of this lower chart. But there is this profit zone. Whenever you have a position in an asset, you can click this profit zone, and it's going to open up a section over here and show where you're profitable. This line is your break even. It's just another way to look at it, much like the graphic analysis. It has the same type of information. Up here in the gray bar is where it shows what your position is. This is a pretty simple one. If I were to actually add a trade and make this something like, I don't know, maybe I'll go farther out. Low. See, now it's like Straddle. When I do that profit zone, now you can see here's where I'm going to lose money, and I'll make money on either side. So I think that's a different representation where it shows it over time, where you're going to make money or not. I don't know how many people actually know that's there or use it.
Yeah, I use that all the time.
Let's see. Another thing, I just keep it on Gilead, is how many people realize that we have the show earnings announcement states, where if you click this button, it's going to show you little blue triangles wherever the earnings was. And of course, right after earnings is where you often see these gaps like this. So let me take a look at a Volti chart. I'll just go back to the SPX. And our Volti charts, they're pretty simple. That the blue line for the implied volatility and a red line for the actual or statistical volatility. And you can go through and look at it day by day. The readings at the bottom of the screen. But much more, I think, interesting is you can put a little table and clicking this V button just to see what statistical implied have been historically, up to 6 years on average. But here, with our horizontal modeling now, if you click this M button, now instead of just two simple lines, you're getting a 30-day, 60-day, 90-day, 1 year, and 2 year implied volatilities. And you can actually see the whole volatility cone and where they are. So you can see they're right here, they're in this graph. And you see this cone. This cone is a 3-year cone, 3-year volatility cone. That means that this line has been anywhere within this cone over this last 3 years. So as you drag this thing back, you can see how the thing moves. And here's where it got near the top. It looks like right there, you can see the edge of the cone. Here's where it hit its high in the last 3 years. This is a weekly chart. You can change it to daily if you want. You can see it day by day how the skew changes. And of course, you can see how when you're putting on a trade right here, you know that there's a good chance this entire line will probably come back down more into what's more average for volatility, which it did. And of course, you can see when something's very steep in the short term, like here, that chances are that will quickly come back. So you should take that, go to this one that's a little more, when it's dramatically pushed up in the front, you can take a look at the price chart to see maybe what was happening. And you can see the market had just dropped a lot. That really pushed up the short-term volatility. Well, you know when you're placing a trade that that's going to be coming back to average. So you should take that into account when you're analyzing or placing trades. Just go back, see if I'm missing. Can I see in this chat? I don't see the chat here.
Yeah, Dave Stewart had a question. Hey, Dave, are you on?
Oh, here's the chat.
Yeah, can you hear me?
I can.
Oh, I just asked him, the T plus X line, when I go to the analyze graph, has switched and it goes right to the expiration line. Before it always defaulted, it had tomorrow's date, and it defaulted to that line.
Okay, actually have it in here to look at some of the preferences, but let me just take a look, and I was just looking at that one. Go into under settings here and preferences. There's a few preferences, and the graphic analysis has the most. Now,
oh yeah, I remember now. So just change it in there.
yeah, there's here's where you auto highlight. What do you want to start? Where do you want to highlight? T plus 0, the second line, and then right under here, you'll see I have second line. Always make second line be T plus, and you choose what you want. I put T plus 1. That's how you make sure when you're analyzing, you're always going to get the T plus 1 line, and I have it so that line's the one that's highlighted when you open the analyze.
It'd be nice if you could make it that second line be the midpoint and have that highlighted too.
If you do not use that setting, that's what will happen.
Okay.
If you don't have this, you make the second line will be the midpoint and it will be highlighted.
That's perfect.
But if you want it to be the next day like he's talking about, you need to include this setting.
Yep.
So let's just look at that that call I have in Guild. Well, now it's a straddle, but I analyze. So you can see the second line is T plus 1 and it's highlighted. I can expand the number of lines, but you see it still has T plus 1 now. But when I expanded, now it went up to more of a middle line.
And the nice thing with having T plus 1 is you can see what your standard deviation lines are for tomorrow.
Right.
Yeah, right.
Now, sometimes it gets, it's a good time to go and to look at some of the earnings. So I do have some earnings coming up. If you're interested in stocks and trading earnings, in the tools here, there is right here a search for earnings plays. It's available to anyone. Comes up and you choose to list companies that are announcing earnings, anything up to the next 5 business days. And what day you want to start. I'm starting today. And down here, there's some check boxes. You'll see I chose select all option stocks. This is all stocks, whether they have options or not. I only want ones that have options. And you can choose to exclude stocks that are less than a certain price. And you can choose to exclude stocks with a DVO, which is dollar volume options traded on average per day of less than, I put 50,000, just to try to keep it relatively liquid. And so you see here's what I have: Adobe, AutoZone, just a few. And I can choose to say add them to my quotes display. So I come down here. Here's my few stocks that are announcing in the next few days. Adobe is tomorrow. And it's after the market closed tomorrow, which means that it's actually overnight, that they'll open on the 20th is when it will move based on whatever they say in their earnings. AutoZone, I see, is tomorrow before the market opens. So you would have to place a trade before the end of the day to take advantage of this one. Let's take a look at what AutoZone looks like. So the key thing I wanted to show is here in the front, you'll see all these IVs. At the money's at about 70% at the money call. And you can see just a little bit long next week, it's already down to 47, 40, 37. So as soon as they announce tomorrow morning, boom, that's going to drop at least like 25, 30 points. And when you say, well, what if I think it's going to do well and I buy a call? Let me push this up to 3 lines. It's showing, and immediately automatically goes to T+1 anyway, even if I didn't have that setting, because it knows right here there's an expected event modeled at T+1. It tells you right there in the bottom left. So it's always going to choose that day, and it's going to show, you can see there's a dramatic drop in the value at the same price, and that's because volatility is dropping. That call is going to lose a lot. And you'll see these little diamonds here. The diamonds are based on the last 8 earnings, last 2 years of earnings, that when it's gone down, on average it's gone down that percentage, and on average it's gone up this percentage. You'd probably see it a little better if I made it a straddle. Let's see what they're pricing the straddle at.
They've got a 5.5% expected move.
There you go. They're pricing the straddle that it's going to move at least 6%.
Yeah, right around
7%. There. And you'll see that's pretty close to where these diamonds are. What is on average, what it's done. Now let's take a look at the actual modeling though. Here's what OptionVue is doing. If you go to the model, the volatility, here's the actual model, and you'll see over here it shows it's expecting a change in this expiration salty weekly 4, which is this first month here, or first expiration here, and it's saying the event date is September 19th, and here's what it's projecting it's going to do for each of these times. You can clear that out. Say, here's what the current skew is looking like. You can see how far up it's pushed there. You can see you could just drag this one down if you wanted, and it brings the whole line on average with it. Or you could do what OptionVue is projecting, which is use this flatten the curve. Here's what OptionVue thinks will happen to it after earnings are announced. So it's not just moving down the weekly 4. The 30 days moving down a little, 60 day a little bit, 90 day a little, but much less, 1 year, 2 year. So the whole curve is going to shift down that way, and that's what's brought into this graphic analysis when we hit analyze with this trade, this kind of a drop. Also mention, whenever you're looking at trade and you're kind of wondering, what is it projecting there? when I hit Analyze, you can always, I have right now the T+1 line highlighted. You can always see it's got like a little asterisk there. That's the one that's highlighted. If you have trouble even telling which is, you know, a little brighter. Down here in the bottom right is this D button, Detailed Analysis based on the WAN price. And you'll see it's for tomorrow. It's projected this voltage change. Then it's going to show you each leg. And right here, it's going to show you what voltage is it using to calculate this theoretical price that it's going to project that you're making or losing this amount of money. So right here, you can see the actual inputs being used because you got the price you're projecting. You'll notice if I change it, maybe I make it, it shoots up to 610. I'd make a little money. And you'll see if it hits this price, here's the strike prices, and here's the voltage it's using, and you know the number of days, just one. Those are all the inputs being used to calculate this gain and loss. So you can see it right here in this detailed analysis, because the voltage is the key thing, knowing what voltage are you using to calculate that profit loss. See what else we got coming up. Had Adobe Systems, Bed Bath & Beyond, CarMax is coming up. Those who, we do have an earnings module, and they, we have some things like E-primes that we search for. Those are stocks that make big moves. That over the, again, we use last 8 earnings over the last 2 years. Those that have moved more than the market makers typically price them at. You have E-overs, and those make smaller than expected moves. Like if you sold a Straddle on it or a calendar, and CarMax is one that typically moves less than what they price it at. So this isn't due for another few days. I'm sorry, what was the date again? 9/22. So it's coming due right on this. They're going to do earnings right on this day. This would not be the time to place a trade on this, but if you, let's see what happens when you sell a straddle. It's going to say, on this day, notice it defaulted, despite my settings of T+1, it defaulted to T+4 because that's the day of the event. If there's an event being modeled, it's always going to default to that event day rather than your setting of T+0 or 1. And in this case, it's T+4. And it's showing me if it moves less than 6% up or 5% down, then I would make money in here. Looks like this little green arrow is telling me here's where it moved last time it moved up. And this red arrow is showing the last time it moved down, here's where it moved down. And then again, these diamonds are telling me the average up and down moves over the last eight earnings. So you can see last time it would have been right here, so you would have made money if you had done sold a straddle or strangle. Most people, of course, don't want to do a naked straddle, so you'd probably want to do instead a calendar. Should be something similar. It's going to bring you right in there. Okay. Let's see. One thing I wasn't that sure about, what else do I have in this account? I have an existing position. I have 2 crude oil futures in February. So let me look at some futures. I was going to suggest just make sure people understand that they can use like the trade finder when they already have existing positions to look for adjustments, not just for like brand new trades. So let me open crude oil. And where's my existing position? I have two of this February futures contract, which is pretty simple. I also had potential trades, clear trades. Just looks like buying and selling a stock. Goes up, you make money. It goes down, you lose money. But I had on a price chart, one other thing you can do on a price chart is put a target. Here's the target button. If you click this, it gives you a little box. You can drag it, move it around wherever you want. I have this out to February because I have those February futures. How wide a price range, you can make the box wider or move it. I have it going to January 18th because that's when the futures are expiring. And then once you have this target set up, you could put it anywhere in here in any size box. It shows here's the price range I have set, 46.5 to 54.75 from January 10th to the 18th. That's the width of the box. So when you go into Trade Finder and I bring in crude oil, when I go to the target, it automatically brings my target in here. And it tells me I'm projecting the price of the February futures contract. And I was going to look at doing a collar, like selling a call and buying a put around those futures. You need to put a goal in, and then you can include your existing position in analysis. One key thing is when you're including an existing position, in this capital provided, you first need to have enough capital to cover your existing position. Like the two futures cost about $6,700 in margin, plus enough to make it a trade. So it has to be more than your existing position is right now. And then you just hit go, and it's just going to recommend adjustments to your existing position. So collars are a pretty easy thing to do around a stock or a future, especially if you're worried about it dropping. Kind of hedge it, but selling a call to pay for some of that protection, so it's not so expensive. I see it suggested first this selling two of these calls and buying two of these puts. Actually selling these calls at $3.78 and buying these puts at 82 cents. So I'm actually going to get a net credit for it. So it'll actually reduce the amount of cost of my trade. So let me send this trade to the matrix. See where I'm at? I'm right here. Selling this, pretty much an Antimony call. This put, I'll analyze it. And that's what it looks like. I could superimpose, and I'll just go down to one line so you can see it. One line. So here's just my futures position, and here's the collar. And this shaded area is my target. So you can see if it drops, especially if it drops a lot, 38, I'll save some money. But I don't know how many people have ever tried using that. It's also very useful for people that have quite large positions in the indexes that are delta neutral traders, because once you choose to include the existing position analysis, then it becomes available to scale recommended trades to help an existing position become delta neutral at the current price of the underlying. So if you're trading a delta neutral position, the market's moved, and you want to make an adjustment to bring it back to delta neutral, you can include your existing position, make sure you bring enough capital to cover it plus some, and then click this box to scale it, and it will recommend trades that will bring your position back to delta neutral. Let's see. Where am I at? I'm at about 35 minutes. Let's see. I'm looking for the the chat, see if there's any chat I'm missing.
Oh, that should be up at the top. I don't think there's any new chat messages.
Oh, I didn't really have anything else to go over. Those were a few of the things I wanted to bring out, and that came pretty close to half hour.
Yeah. Just quick question. I know you and Len are working on those volatility changes. Do you have a rough idea when you hope to release that update?
He's expecting it to take a minimum of 2 months.
Okay.
And with testing, we're really looking at targeting the beginning of next year.
Oh, that makes sense.
Pretty big project, and it's going to require a tremendous amount of testing. And, of course, we're going to have a fairly large beta testing group for this for people who are interested in trying it. So,
if somebody does want to help, if they do want to help test, what should they do?
Yeah, they can email me directly at jim@optionvue.com or just talk to your rep and let them know.
Very good. All right, Jim. Like I said, no more questions. Really appreciate you coming on and going through a few things and giving us an update on what's new with OptionVue.
All right, thanks a lot, Tom.
All right, thanks everyone.
Time in Portugal.
Yeah, thanks. It's great. You have to come sometime.
Yeah, I'd love to.
All right, we'll see you, Jim. See you, everyone.
All right, bye, everyone.